Just to turn back to some kind of market implications, Jay Bryson with us from Wells Fargo. Jay, I know you're looking at this more from the economic side of things, but this is now an economic outlook and an inflation dynamic and a fiscal dynamic that's, I guess, as bad as, I don't mean bad, but as kind of bearish for rates as it could be right now. What turns the tide?
Well, I think what would turn the tide, Kelly, is you get, good news in terms of the inflation front. So we're going to have the CPI coming out, next week. If you get a decent CPI print, that puts some maybe downward pressure on yields. Another thing would be on Friday, we get the employment report out. You get a weak employment report. People start to wonder, is the economy starting to, really start to soften here? So I think it would be the combination of weaker economic growth in terms of the real side of the economy, as well as on the inflation side, that could potentially turn the tide for yields here.
Sure. So you see a scenario, and I mean, does the size of the deficit, does the debt dynamic, does that factor in at all, Jay, to the outlook for next year?
Oh, sure. I mean, when we're talking about turning the tide, it's more of a cyclical sort of thing, near-term sort of thing. I mean, let's face it. I mean, unless, the economy goes into a hole sometime soon, we're not going back down to where Treasury yields were 2 or 3 years ago, down below 2% or something like that. So, yeah, you could get a rally in here where rates come back down a little bit. But again, in order to go back to those lows we saw a few years ago, something really bad has to happen to the economy, just because the fiscal deficit now and the debt concerns are so much bigger than what they were just even a few years ago.
Steve, the ADP number this morning wasn't that great. I didn't see much, if anything, yields went to their highs after that report, even though it was a miss. And the expectation for Friday is around 150,000, right? But that jobs report will be another chance for us to test the market.
Yeah, that's right. People are calling it the, what did I read? The no hire, no fire economy. And we'll take a look, by the way, at the Challenger job layoffs data tomorrow morning that we'll get. That'll give us a clue as to what's happening. But you saw those jobless claims down near a recent low, just a tick above 200,000. I think that's a pretty big deal. So we're not losing jobs, but we're not gaining them at the same pace. That's kind of normal. I think the key with the job market from the Fed standpoint, the Fed chair said this several times, that the job market is not a source of inflation. And in fact, you can imagine that if you read Waller this morning, that the job market could be a source of disinflation through the service sector if indeed you have wages rising at a slower pace. So that's a good thing. I think Jay is absolutely right. You need to have something take the froth off or bring the economy off the boil, the sense that we're not plunging ahead. One good part about this that's not discussed a lot, and I want to see what the discussion is in the minutes, Kelly, is this productivity story that we talked about.
True.
I think it was last week, this notion that you have this upward move in productivity. And Waller said it today, what we had said last week, which is that raises the neutral rate. It does allow the economy to run hotter, but it also is a reason why the terminal rate and the sense of where the 10-year is should be higher for that reason. Add in that the fiscal deficit. So if you got a little clarity about spending from the Trump administration and how they were going to deal with fiscal issues, we might come off the boil when it comes to interest rates.
I absolutely agree. Jay, I'll give you the last word on that. What do you think is going on with productivity here?
Well, if you look at the most recent productivity numbers, there has been some acceleration going on there. Now, is it because of capital spending or technological breakthroughs like AI or something like that? I'm not convinced that that's necessarily what it is. I think it could be what's going on is a reflection of the tightness of the labor market over the last, say, number of years. And, businesses out there realize that, okay, it's not like we have workers just laying around everywhere. We've got to do things a little bit smarter here. We have to tighten up our processes. And that may be what's driving these productivity numbers right now.